Crocs reported earnings before the market opened on Thursday, and results were really solid. The Crocs brand, that core business, is doing extremely well. Hey Dude continues to struggle, and that's really the question mark for the company. But shares are now trading for 10 times earnings. Shares fell a little bit in trading on Thursday, down about 3%. They actually opened a little bit worse than that. So it kind of looked like it was going to be this great buying opportunity, but it only lasted for a short amount of time. So we'll see where shares go over the next few weeks. But I think operations continue to get better for Crocs in particular. And the good news is that the second half of the year, particularly the fourth quarter, is when we're going to lap some of the worst numbers for Hey Dude. So that brand may start to go from being a detriment to revenue growth to a positive. We'll see how that plays out. But that's really, I think, the biggest bullish potential for Crocs is if you go from a really solid Crocs brand and a terrible Hey Dude brand to being pretty solid on both of those, may earn a little bit higher multiple than high single digits, which is where the stock is trading today. That's what I'm going to dig into today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get right into earnings. This is the investor presentation. This is what I'm going to use as kind of a baseline. The high level numbers, revenue was up 5%. That was a little bit better than expected. That was driven by the Crocs brand, up 11% in the quarter. They were expecting kind of high single digits was what their guidance was, but North America was a little bit stronger than expected, up 3%. And then international. This is the opportunity for Crocs, is to grow in international markets. They have been doing that, up 22%. And a lot of that is led by direct to consumer. Hey Dude, down 17.5%. That was within what they expected, so no huge surprise there. And the wholesale is really where they have the worst numbers. This is where they went through a major strategic change about a year ago, got rid of a whole bunch of their retail partners, and they're trying to move into a little bit higher price point. So there's been a lot of declines in the wholesale business over the past year. So again, this is what's expected, but this is what is going to make your revenue grow 5% instead of growing in double digits the way the Crocs brand did. Adjusted operating margin, just phenomenal at 29.3%. And earnings up 12% to $4.01 per share. Nice balance between wholesale and direct to consumer. I just want to highlight that because there has been a number of different brands that have been trying to make a transition to direct to consumer, particularly Nike is the example of that. Crocs has grown up in a little bit more of a dual or omni-channel universe. So they've been able to handle this a little bit better. So just wanted to highlight there's a nice balance there between the two, and international is still opportunity for growth because it's only 43% of revenue. The Crocs franchise continues to grow. You obviously have the core Crocs clog or sandal, but they're now moving into different styles of sandals, funky looking sneakers, even some more kind of normal looking sandals. And what I think Crocs really brings to the market is this is a much lower price point than a lot of other competing products. You're going to be able to sell a Crocs shoe for $40 at retail and still make a really, really good margin as Crocs in excess of 60%, because the cost to actually produce these is only between $6 and $8. So really nice to be in that position, especially as consumers start to pull back and actually trade down to a little bit lower cost goods. Maybe Crocs will be one of the brands to benefit. Hey Dude, again, going through some different strategy changes, opened 13 new outlet locations, bringing that to 19 for the year, and establish Wally and Wendy icons. That's what they're going to try to use to help grow that brand in the future. Here's some pictures of the Wally and Wendy branding and the products that they're looking at. So again, kind of to be determined as to whether or not that is going to be successful, but that's the strategy, is to try to be in fewer wholesale locations, move a little bit higher market, and be able to benefit a little bit from the distribution and the relationships that the Crocs brand already had. And you see that here, leverage the Crocs playbook in international markets in particular, maintain price integrity. I think this is one of the big things, is that you used to be able to see Hey Dude shoes be able to be discounted at a lot of retailers, and they were just trying to get them off shelves. That's not good for your brand look. So they may be able to turn that around by working with fewer wholesale partners. The other great thing is that Crocs has been able to grow while maintaining their inventory at really nice levels. 14% year over year decline as you're growing revenue 5%. That is exactly what you want to see from really good operations. And then finally, the full year outlook. This is actually what was a little bit disappointing for investors, because they didn't change much in the full year outlook, except to say that they expected earnings per share to be a little bit higher. Now, earnings per share guidance, they don't actually include share buybacks. So that's the denominator of the earnings per share number. So if they decide to buy back more stock, that is going to boost your earnings per share. So that actually gives them a little bit more upside because they have been doing buybacks. But that was really the disappointment, was that it seemed like some of the numbers from Q3 were maybe pulled into Q2 a little bit. That was why they didn't increase these guidance numbers, especially for revenue from the Crocs brand, for the full year any more than to 7 to 9%. So maybe being a little bit conservative there, but that was how I read into both the comments on the conference call and actually the official guidance. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Overall, I think operations looked really strong for Crocs. The Crocs brand in particular is doing extremely well. Like I said, the upside long-term is going to be Hey Dude actually turning things around and actually becoming a real growth business. But the other thing is the valuation for the company and the stock. And this gives management the ability to buy back shares and actually be really accretive long-term. I want to give some of those numbers here. They said that during the quarter, we repaid $200 million worth of debt. So actually taking operating leverage. So actually taking financial leverage off the table as well. And repurchased approximately 1.2 million shares, $475 million. And another $700 million is authorized under the current share repurchase program. So they are returning capital to shareholders at a really rapid rate. That is absolutely the right thing to do when your core business continues to grow. It doesn't require a lot of capital to be able to grow that business. And you have a really cheap stock. And that's exactly where Crocs sits today. Just using the share price right now as I'm recording of about $43 and the high end of earnings per share guidance, $12.90. Shares are trading for 10.1 times earnings. So that's a really good valuation for Crocs. And as I mentioned, that's where you want to be buying back stock. You don't want to be buying back stock when there's a stock is at a 30 or 40 PE multiple. You want to buy it back when it's at a single digit PE multiple. And that's exactly what you get for Crocs. So just another solid quarter for the company. Lots of questions about the future of Hey Dude, and we're probably not going to get those answers in the third quarter. Expect those more to come in the fourth quarter because that's when you start lapping some of the numbers that are going to be negative comps. So we may move to positive comps, meaning year-over-year growth numbers at Hey Dude. So that's going to make the numbers look a little bit better. 2025, if some of this momentum continues, the company overall could potentially grow in the double-digit range. Again, if we start to see Crocs overall growing revenue double digits, now the stock doesn't deserve to be worth 10 times earnings. Now it maybe deserves to be worth 15, 20 times earnings. And that's really the upside, is not just that operations are doing well, but you're getting a better multiple from the market as well. So think about that when you're looking at Crocs stock. But let me know what you think about the stock and about the quarter and the performance of the company overall. Leave those comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.